If you compare to last week, you can basically see our portfolio value went from $13,500 to $14,600, which means that as the market rebounded, this whole portfolio basically recovered over $1,000 in the past week. Now, if you take a look at our portfolio, you can actually see we increased our options position and we have over $11,000 of cash to deploy. Now, depending on your view of the economy, some people may say that it's actually quite urgent that we start deploying this cash. And while I don't fully agree with the urgency argument, I do want to start allocating this capital over the next couple of weeks. That is not to say I do not hold any more concerns about the economy. I still hold some of the same concerns as I expressed a couple of weeks back. However, I do believe we do need to take a more balanced approach when allocating the portfolio. What this means is that I want the portfolio to be at least 70% to 80% allocated into equities at this moment. And basically, if you take a look at our allocation, we still have about another $5,000 to $6,000 to allocate at this point. So before we take a look at this portfolio, I think it's important for us to take a look at some of the data that actually came in this past week telling us about the economy and then move on from there. While everything seems smooth sailing on the surface, why is it I still hold concerns that a recession may be possible? So let's take a look at some of the economic data that came in the past week. So basically, we received the PPI on Tuesday. Year over year came in at 2.2% versus 2.3% expected, and month over month came in at 0.1% versus 0.2% expected. So for those that are kind of new to this, right, basically this is a measure of the change in prices that domestic producers basically receive for their output. So a lower number just signals that, inflation is slowing down. So when PPI came in lower, of course, markets tend to rally. Now, not to be too technical, but when I was listening to CNBC, some people basically complained that the PPI was only low because of this component called trade services. Excluding that, you actually get a higher number for the rest of PPI. Why is that a problem? I don't want to get too technical, but basically what they are actually arguing is that trade services don't actually affect the consumer as much. They are not really felt directly by consumers. And so inflation that is actually felt by the consumers, you have to remove trade services from it. And when you remove trade services, PPI actually came in at a month-over-month figure of 0.4%. So annualize it, he's basically arguing that, inflation is actually still about 4.8%. This is a little bit of a weak argument, but I do see their point because, from what I understand, inflation tends to come down over time. It's not a straight line down. Sometimes there are certain one or two data points here and there that actually show that, inflation is not fully extinguished yet. So basically, if I were to take everything into context, consider what Powell actually told us, they are data dependent, not data points dependent. I think looking at this data, what it means is that, inflation is coming down. Yes, there are still certain areas that might be a little bit hotter than we expected. And what that means is that in September, we could expect a 25 BP cut instead of a 50 BP cut. I think that's about all. I don't think this is cause for concern that, the Federal Reserve are not going to cut higher for longer and things like that. Now, the second piece of data that we're looking at came in on Wednesday. CPI year over year came in at 2.9% versus 3% expected. So the CPI core came in at 0.2% month over month, which basically met expectations. This is largely in line with the data that we received from PPI that came in on Tuesday. So it's basically the first time since 2021 that inflation has come in below 3%. So I think that's good. And I think these two reports largely kind of cements that, in September, we are definitely going to get a rate cut. Now, I think basically markets are having difficulty pricing in whether or not it's going to be a 25 basis point cut or a 50 basis point cut. Now, I think if you consider what Powell has said previously, although both inflations and jobs are basically considered now in equal measure, he actually did say that the truth is that we are still further away from our inflation target compared to our jobs numbers, right? So basically, because unemployment is actually at 4.3%, which is still acceptable, inflation is not yet at their target. So while they are considering both sets of data equally, he also did say that we are still a little bit further away from the inflation target. So in my opinion, it's unlikely that they'll do a 50 BP cut unless between now and then we get some very clear signs of slowing down in the economy. So that's why you do have to listen to the end, because right at the end, I basically talk about three things that will affect the Fed's decision moving forward. And these are things we need to pay attention to so that we can stay ahead of the curve. I think the final data point of the week that came in was retail sales, which came in at 1% versus 0.3% expected. And with all of these data, basically it tells us that, hey, you know what? So far up to now, the consumer hasn't really been affected. And with lower unemployment claims that also came in on Thursday, right? I think the markets rallied into the close of the week. And to top it all off, Iran and Israel's conflict did not escalate in the past week, which means all is well and good, right? So that means we can go all in into the market right now, isn't it? Well, not quite. You see, to me, all this data that we received in the past week, right, is basically backwards looking data. So basically what he has told us is, you know what, despite the high interest rate environments, company has done well all the way until middle of the year, June 2024. In terms of the consumer is still strong as of July 2024. The economy and the consumer is doing fine as of now, despite the high rate environment. You have to remember that the effects of higher rates is basically a lagging effect that is felt in the economy. So I think what investors are a little bit unsure of right now is whether or not, all this good data actually signals that, our economy is really strong, really healthy, it hasn't been affected by the rate cut at all, or whether or not the lagging effects of the rate cut just hasn't affected us yet. And so one of the things I've learned over the years, right, is that basically some of these economic data can't give us a full picture of the economy moving forward. All it can tell us is that the consumer and the economy is doing fine as of this point in time. And so unfortunately for the Fed, right, basically they work with this kind of economic data that is generally backwards looking. They don't do much of predicting how the economy is going to be because nobody actually really knows for sure. So if all the economic data that we have is backwards looking, does that mean that there's completely no way for us to ascertain how the economy and how the consumer is going to perform in the coming quarters? That's not exactly true either, because we can generally get a sensing by listening to companies' earnings calls. One of the things I've come to realize over the last couple of years, right, is that during all these quarterly earnings calls, it is the job of the CEO and the management not just to report about the past quarter, but to give investor guidance about the quarters ahead. And because of that, the data that they're working with tend to be more forward-looking, and they can actually give you a better understanding about the present-day condition of the economy and the health of the consumer. So one of the things I realized over the years, right, is that before this inflation started to spiral out of control, when you listen to the earnings calls during that period of time, right, you can actually hear companies telling us that, you know what, we can keep raising prices because even though we are raising prices, consumers are still coming to us, they're still buying our products, they're still using our services. And so this was basically an indication to us that, hey, you know what, inflation is going to eventually show up in the economic data, and it did, and it spiraled out of control. Using the same logic, that's how I'm basically looking at the company's earnings calls today. So when you look at some of these companies that just reported their earnings, broadly speaking, the sentiment is that, you know what, the economy is still healthy now. However, we do see signs of the consumer slowly moderating their spending. They're being a little bit more cautious in how they spend their dollar. So some of these companies I look at are really companies that provide everyday service. So companies like McDonald's, right? Same store sales down 1%, falling for the first time in 4 years. And the last time that happened, that was actually due to the pandemic, you see. So if this was only McDonald's, it wouldn't be so concerning. But we actually do see this happening in some other companies like Starbucks. Same store sales down 3%, losing market share in China as well, right? They have other companies there like Luckin Coffee starting to pop up and basically taking away market share from Starbucks. Amazon also talked about a weaker consumer, consumers being more picky with where they spend their dollar, gearing themselves more towards the value-oriented products and things like that. And we actually also see PepsiCo CEO, this is what he actually said during his earnings call. He says the US consumer is much more price conscious and demand is suffering after years of price hikes. Then we actually see here the Mountain Dew owner reported that PepsiCo Beverages North America saw volume fall 3% year on year during the company's second quarter as a result of falling demand. So McDonald's falling demand, Starbucks falling demand, PepsiCo, which owns a lot of other brands under their whole brand name, basically also falling demand. And not just that, when we talk about the travel sector, we see airfares basically falling. Airbnb tell us that, consumers are moderating their demand again. The booking times are getting shorter and shorter, which actually shows weaker demand. Disney actually also tells us, moderation in terms of park goers, people going to their theme parks and things like that. So all in all, I think we can actually see that, although the economy is still doing well, it seems like the consumer is being a little bit more price conscious already. As investors, right, what can we take away from this? Basically, there are one or two possible outcomes. The first outcome, which is basically what everybody is hoping for, is a soft landing, right? This is just a normalization of demand. Consumers have very high demand, a lot of pent-up demand over the last couple of years. Everything is basically starting to normalize now as things really start to get back to normal. The second possible outcome is one that basically got investors a little bit worried over the last couple of weeks. So basically what happens is that, if consumers do start to spend less, and then companies actually start to spend more capex in terms of ramping up their AI, they actually earn less, they actually spend more on capex. What happens is that basically they have to keep themselves profitable, maintain their profit margins, and they do that by laying off people. When they lay off people basically lose their source of income, they start to spend less again, and then this is basically a whole vicious cycle that causes a recession in the economy. If I were to look at this objectively from the Federal Reserve's point of view, right, they're basically stuck between a rock and a hard place. Now, one of their concerns definitely is recession. They do not want to see unemployment climb. However, at the same time, they also don't want to see inflation resurface. And basically what is the concern now is that, if I lower rates too fast and inflation comes back, then that is a problem. But if I don't lower rates fast enough, people start to lose their jobs and we cause a recession. Now, between inflation coming back and between causing a recession, if you ask me, I think the Federal Reserve is more concerned about inflation coming back, because recession usually is temporary. It may be extended 1 year, 2 years, and it is bad because people really do lose their jobs. The lives of people are affected. However, if inflation does resurface, if inflation really spirals out of control, we can actually see the whole economy collapsing. And basically the damage of inflation spiraling out of control is not not one that, economies can come back from easily. Now, on a side note, right, Walmart actually did quite well and they said that they don't actually see any notable deflation. However, when you listen to their earnings calls, right, what actually happened is that they confirm what Amazon has told us. You see, during their earnings call, they actually tell us that, we don't see any notable deflation, their earnings and everything is still good because they are getting a higher share of higher income families. And to me, that could be a recession play. You see, what did Amazon tell us? Consumers are more price sensitive. They are going for the more value-oriented option. So what could be happening at Walmart very easily is that basically, lower income families may not be shopping there anymore, going to the more localized supermarkets and things like that instead of going to Walmart. And higher income families who may not usually shop at Walmart now basically come into Walmart. And because these higher income families tend to spend a little bit more at Walmart, they don't actually see any declines in their revenues and things like that. Unfortunately, during recession, right, it's true that some families will be more affected than others. So you consider a family living on $2,000 a month. If somebody loses their job during the recession and basically the household income gets cut in half, basically living on $1,000 a month, it makes a large difference to their quality of life. Compare that to a family which maybe have, a household income of $20,000, right? Even if one person loses their job, they're living on a household income of $10,000, they can still get by pretty comfortably. So in a sense, when you listen to Walmart's earnings, on the surface, yes, it may seem that revenues are fine, profitability is good, and things like that. When you listen to the earnings call, what you actually realize is that maybe what is actually happening is that as the lower income families stop shopping at Walmart, the revenue that they lose from there is basically replaced by the higher income families coming in. All this falls into Amazon's narrative of the consumer being more price sensitive, being more cautious on when they spend their dollar, and going towards more value-oriented options. So if you look at everything as a whole, what this has basically told us is that macroeconomics data came in good, right? So that is a backwards looking data, but at least it came in good. Investor sentiment has been improving since the Japanese carry trade. However, if you take a look over here, right, investor sentiment is actually still fearful, but it just that went from extreme fear to basically just normally fearful only. So technical indicators, if you look at the SPY and triple Q, both actually bounced off their moving averages, but companies' forward guidance is a little bit concerning. So generally, we have good data, bounced off the moving averages and things like that, but moving forward, companies actually tell us to expect a weaker consumer. So what does this mean? This actually means that, there's a recession risk still present. There's no telling when the recession might happen, how long drawn it will be, or how severe it will be. And I think one of the things that can actually paralyze investors, right, is that when you look at all this data, you are fearful. You're like, what if this, what if that, and you don't end up investing. And the worst thing that could happen is that when you don't end up investing, the recession may not be as bad as you expected. The market continues to run and you basically miss out. And then because of this psychological effect called price anchoring, you saw the stock at this price back then, and now because it's maybe, up 50-60%, you don't actually buy back in, and then you end up missing out the whole bull market. So at least for our portfolio, that's what I want to avoid doing. Basically, despite all the concerns I have, I want to be at least 70 to 80% invested. So if you can see, we actually have nearly $12,000. I will look to allocate that over the next couple of weeks. Now, one of the things I'm aware of, right, is that moving forward into September and October, that's historically very volatile and poor performing months in the stock market, especially September. If I'm not wrong, there's this thing called the September effect. Yeah, apparently I googled, right, there's this thing called the September effect where over the last century, since I think 1929 or something like that, September has been generally the worst performing month in the stock market. That's not to say that this is a rule that will always happen, but that's just something that I like to look at and say, hey, there's a trend that, September is a poor performing month. And if that is true, that actually bodes well for us because we have all this pile of cash sitting on the sidelines ready to deploy. And so moving forward, the plan is to be at least 70-80% allocated by the end of September and to be fully allocated by the end of October, going into the US elections in November. So you see, generally after the US presidential election, the stock market does well because there's clarity about who the next US president is, the kind of policies that he or she will implement and things like that. So because of that, the stock market tends to do well after the US presidential election. However, that is also with the caveat that, hey, be aware that there could be a recession upcoming because of what we have already done in the economy so far. However, we do not want to let that fear or the uncertainty about a recession basically stop us from investing because recessionary cycles are part of the economy and they do happen all the time. And if you are long-term investors, you are definitely going to experience multiple recessions during your lifetime. And like I always say, you basically can combat it two ways. Number one, using a long-time horizon. So if you have a long-time horizon, then you can just basically tide through the recession. Otherwise, like what we're doing on this channel, you can actually use different option strategies to still generate you an income even though your stocks are not performing well. And that is why I need you to hit the like and subscribe button right now before we carry on. Thank you, and back to the video. Now, if you remember right at the start, I basically said that there are three things on the horizons that we need to pay attention to inform us how we want to allocate our portfolio. But before going to that, let's take a look at where our portfolio is right now. Now, if you remember the first position that we have, the 100 Intel shares that was assigned to us, right, basically at $29, once you net off the put premium that we receive, the adjusted cost basis of this is basically at $27.60. Now, 2 weeks ago, we also sold a $16 cash secured put on this position to lower the cost basis, and so that is expiring on the 23rd of August. And in the last week, we basically sold another aggressive cash secured put at $23, but this one expiring 1 month out on the 13th of September. So on 23rd August, if this doesn't hit $22, we get to keep the whole $16 here. And if the same thing happens on 13th of September, it doesn't hit $23, we get to keep the whole $25 and basically lower our cost basis to about $27.19. So let's dive into the mathematics and see basically how we can actually eventually turn this profitable. Now, if you look at it with me, we actually have the adjusted cost basis of $27.60. Now, we received the premium of $16, which actually net off 16 cents. So our adjusted cost basis from the first covered call makes the whole position worth $27.44. If, let's say, we fall asleep at the wheel and these 100 shares get called away at $22, right? Basically, we suffer a loss of $544. Let's say we don't fall asleep at the wheel and this whole position expires worthless. Let's take a look at what happens. So initially, the position is have an adjusted cost basis of $27.60. You minus off the 16 cents that we just received, $27.44, minus off the 25 cents that we receive. Now the adjusted cost basis, the new adjusted cost basis is $27.19. Now, on 13th of September, if these 100 shares get called away from me, basically, I received $2,300, which means that my loss is only $419 now. So previously, if the shares get called away from me at $22, my loss would be $544. However, now if the shares get called away from me at $23, my loss would only be $419 on this whole position. How this works, right, is basically as we sell the covered call, there are two components. The premiums that come in help to lower the cost basis from the top. However, as we move up the strike price of the covered call, what we're doing is we're increasing the floor, our minimum selling price of these shares. So as the minimum selling price goes up, the cost basis comes down. Eventually, they'll meet at the point that they're break even, and eventually as the share continues to goes up and we keep receiving premium, this will eventually become a profitable position. Then we take a look at the second company. We have the 500 shares of SOFI here at $7.02 now. So basically, this 500 shares is now worth $3,500. Our 17 cash secured puts at $8 for January of 2025, that is now profitable. We basically sold this for about $1.74. However, now this whole position is worth $1.47. So you can see we're up 15% on that position. And then we sold, like I said, shorter term cash secured puts. Basically, that we sold 5 cash secured puts for $6.50 on the 30th of August, and because of the price movement, you can see we actually sold it for 26 cents. Now this whole position is only worth 7 cents. So I may look to close that out earlier and then sell another cash secured put now at $7 moving forward. And so basically with SOFI, right, I do think that I'm very convinced I want to make this the biggest position in the portfolio. And so moving forward, what I plan to do is I plan to double the SOFI position if they can find some sort of support at about the $7 to $7.22 kind of range. Then that's where I'm looking to double my position. And basically, if anything happens, I'll just sell options against the positions to generate income. So what are the 3 things exactly that I'm looking at? Basically, the first thing on the horizon is the GDP projections moving forward. If you take a look at the Atlanta Fed, right, the GDP now forecast basically showed that we expect a growth of GDP of only 2% in Q3. So why is this concerning? 2% is still growth, right? Well, basically, they actually had a projection of 2.9% earlier on in the week, but with all the data coming in, they reduced from 2.9% growth to 2.4% growth to 2% growth. So that is something that we want to keep an eye on, the projections of GDP going forward. I think another concerning aspect of this report, right, is that basically when you look at this thing called the real gross private domestic investment growth, which is basically how much companies are investing, they actually reduced from, I think, 2.8% to 0%. And then basically, if you look at it as of 16th of August, it moved even further down from 0% to negative 2.4%, which means companies are investing lesser and lesser. So why am I paying attention to this? This is basically, playing into the whole narrative of the economy might be slowing down. Whether or not this is just a normalization or whether or not this is a bigger decline is something that we need to pay attention to, which is why I'm looking at this moving forward. Second thing that I'm looking at is Jackson Hole meeting on Friday, 23rd of August, if I'm not wrong, or is it 22nd? Let me go and take a look. So basically, we want to pay attention to what Jerome Powell says, whether or not he gives us any hint on a 25 BP cut or a 50 BP cut. But I think I do expect some volatility going into that. The last thing we want to look at is the PCE data coming out at the end of August. I think we can expect it to largely fall in line with PPI and CPI data to basically cement the fact that, we are definitely getting rate cuts in September. Moving forward, what are we going to do with the rest of the cash? Now, I've decided to drop my interest in companies like PayPal, Palantir, and Shopify. Not because I don't like them. Actually, these are 3 of my favorite companies behind SOFI at the moment. However, at least in this portfolio, the rule that we gave ourselves is to look for smaller companies, 5 to 50 billion, right? So because of that, these 3 companies don't actually fall in the 5 to 50 billion dollar market cap range. So I'll be, I'll still do videos on them over time, but these won't be part of the portfolio. The companies that I'm looking at that will be part of this portfolio, Number one, Sentinel One. Sentinel One is a cybersecurity software, and I think after you see what happened with CrowdStrike, we actually know how important cybersecurity is, especially with AI moving forward. Enphase, like I said, this was a position that I was interested in earlier. I didn't hold this position is because I couldn't hold 100 shares. But if I don't want to actually sell options on every single position, that is a company I'll definitely be considering. Another company is Unity Software. Unity Software, their previous CEO basically ran the company very, very poorly. They are now in the midst of a turnaround. One thing good about this company is that definitely their price range is suitable for us to sell options on. Another thing about Unity Software is that because they actually power, if I'm not wrong, Football Manager, which is a game I actually like to play. So that's something I'm interested in. And they definitely do have an interesting technology that I want to study more. And another two company that I'm looking into is basically HIMS and Ubiquity. So more on that in the next few videos, and I'll see you in the next one.